What you're missing is inflation no longer matters. I mean, the Fed's not even focusing on inflation. If they were, they wouldn't be cutting. It's, hey, we want to get down to 2%, and you were on your way there, 2.4, 2.3, and that was up to 2 months ago before July, and all of a sudden now it's starting to go up, inflation. Now inflation's going higher. That's a big discrepancy between, 2.3 and 2.7. That's big. I could see, like a lot of times you have capital IQ estimates for GDP data and different economic data. You'll have briefing.com estimates. You'll have the Economist survey. You just have, overall street estimates, and they're like pretty much in line, 0.10 away from each other. We're expecting 0.3 or 0.2. That's a big difference. But right now, inflation's not on the table. This is all about jobs right now. If it was about inflation, the Fed would help. I mean, they held steady at 2.3, 2.4% inflation. So now with 2.7, doesn't make sense for them to cut. It's all about jobs right now. It's not about inflation. I think they'll let inflation run well past 3% right now to 3.3, 3.4, maybe 3.5 in order to make sure that job market is strong, because the job market collapses, the economy collapses. And we're not talking about job market. You could argue, okay, it's AI taking over. It's more productivity, more better jobs, or, better for companies, higher profits. That's a different argument, but fewer people having a job means less money is going into the economy. And these companies are just getting richer and richer where their balance sheets are increasing dramatically, but are they paying that out to employees? Not necessarily. Maybe some of their AI employees, but not all employees. So it's not filtering from these companies back into the overall economy. Maybe in terms of spending and AI spending and stuff like that, it's different. I will say that JP Morgan stat, historically, they said when the Fed cuts market than 1% of their all-time highs, right? It said produce an average return of 15% over the next 12 months. That's a 100% hit rate, 100% of the time. Like every single time the Fed has done this, we've seen massive gains in the markets. So again, this is from JP Morgan basically saying, we guarantee that the market's going higher over the next 12 months. I would like to look at that data more closely since we've been trading all-time highs pretty much for most of 2025 outside of April in anticipation of the Fed cutting rates. Again, we've been waiting for these cuts for a long time, so it's different, I think. But I'm curious to see how the market's going to react. I don't know if we'll be up another 15% from here. It's going to be based on economic growth, global growth, which we're seeing, right, with lower rates. It's going to be based on more, policy following on with more cuts after this. If we're able to cut, we're expecting a lot more cuts, not just 3 this year, but into 2026. I think inflation will determine that then, like 3 to 4 months from now, 4 or 5 months from now, just not right now. It's more about jobs. I've been looking at a lot of stats and statistics about this, and I'm going to blow your mind with some of these things. So all-time highs for the S&P 500 happen to coincide with the least bullish sentiment in a very long time. So it makes sense since every single day on CNBC, other media outlets, they talk about how expensive the market is based on PE, price to sales, and we say you can't really look at those metrics because you've been looking at those metrics for 4 years and you missed the biggest bull market ever. So start looking at different metrics. Start looking at, in terms of their CapEx spend, their return on investment. Start looking at their total addressable market, how much they're capturing. Like there's other things because these total addressable markets have increased substantially. Some have doubled and tripled. Right. And if you're capturing the same percentage, but your total addressable market doubles and triples, yes, your price of sales, your PE, everything's going to go higher, but chances are you're going to see your profits go up tremendously and you're going to fit into that valuation. If your total addressable market is $1 billion and you control 1% of that, your stock's going to be trading accordingly. Maybe it trades at a premium if you're growing, if you're in the right sector, AI technology, right? So, when your total addressable market increases to say $3 billion, now your valuation should go even higher, especially if your technology is good enough to capture a certain percentage of that total addressable market, and that total addressable market increases dramatically. That's what we're seeing with an AI, which I think a lot of analysts are not paying attention to. We are, and that's why we nailed so many winners, when it comes to the AI trend and power and stuff like that. Cuts are needed because we talked about the horrible job market. Again, half of what we thought in terms of the jobs growth over the past 12 months, including the revisions, Daniel, it's close to an 80% decline in hiring. That's recessionary. I'm not saying we're in a recession, but those are associated with recessionary times, which is why Powell pivoted. I didn't understand why he pivoted. Now I know why, because he knew revisions before the whole world knew them. But I'm going to share a couple things with you because why we need these cuts. FICO scores dropping the most since the financial crisis. Student loan delinquencies at record highs. Subprime auto delinquencies at all-time highs. U.S. credit card debt, $1.2 trillion, also an all-time high. I know stocks are at all-time highs right now with a lot of these risks, but it's mostly due to what? It's mostly due to the hyperscalers, right? So it's these Mag 10 companies, which they really are. And if you want proof of that, the Mag 10 companies, and I have this down with the Mag 10 companies, where they account for 40% of the index right now. 8 of those names, Microsoft, Apple, NVIDIA, Google, Broadcom, Tesla, Amazon, Meta, have trillion-dollar plus valuations. They control the market. Now, if you want more proof to show like, okay, well, this market's at all-time highs, I'm going to share some shit with you that's pretty crazy. And this is what, if you're looking from an economy standpoint, Daniel, right, from economics, right, if you're looking at cyclical companies that do good when the economy does good, Trucking, we know very well, has been an absolute disaster. It's still a disaster.
For years.
JB Hunt down 20%, Old Dominion, Knight Swift. Throw in UPS. UPS has gotten annihilated this year. FedEx, ArcBest, right? With the shipping companies, they've gotten annihilated. How come these companies at all-time highs, it's not saying that the economy is doing great. We were under the impression that, hey, the economy's strong. And what did the Fed say when the economy's strong every single time? The jobs market is strong. The jobs market supports our growth. You don't have the job market anymore. You lost 50% of the jobs to revisions. Airlines and hotels starting to roll over. Restaurants have been pretty bad outside of a few exceptions, but you look at Chipotle, they're down 34%, Texas Roadhouse, Cava's down 44% year-to-date, Starbucks, Shake Shack, BJ's restaurants. I mean, you have McDonald's and Darden hanging in there. Look at some of these consumer companies like the staples in General Mills. Down 33%, Constellation Brands down 38%, Conagra down 30% plus, PG&E down 24%. Look at Clorox, Hormel, Campbell, Colgate, names that you heard of that when people say the market's at an all-time high, there's a lot of great names that are getting smoked right now outside of the ones that are in the right sectors. You look at payment companies, right? You should see payment companies, Global Payments, PayPal down a ton. Look at Best Buy, one of the biggest consumer-related companies, right? Down 13% year-to-date. Hewlett-Packard, Keurig Dr. Pepper, Molson Coors, these are names that you heard of. You know, outside of those 10, which include Oracle and Netflix and all those things are on fire, and you see the NASDAQ doing well, it's pretty crazy when you look at this market as a whole, where you would think all-time highs, everything's doing great. Not necessarily. And another thing I wanted to point out, when I just looked at the market, it's rare to see this. I don't know if you see this. The S&P 500 down like 0.2%, as we're doing this now at 12 o'clock, midday. The NASDAQ is down 0.5%. So the S&P is down. The Nasdaq's down 0.5%. The Dow is up 0.7%. Sometimes you see that. Maybe United Healthcare is doing great today. But the Russell's up 1%. How often do you see the Dow and the Russell up while the Nasdaq and the S&P are down? I like to get a stat on that because you normally don't see that. So it's just like a little craziness within the market here where small caps should do very, very, very well in a low interest rate environment.